How you guys doing? Welcome back to today's lesson 38, the 4 indexes that I use. Now, it's probably no surprise the 4 that I use. If you watch my YouTube channel, I use the SPY, the NASDAQ, the Russell 2000, and the Dow 30 Industrial. Those are the 4 that I always use. So today, we're going to talk about those 4 indexes and why they're super important, and we're going to move on to the 11 sectors that I like to look at and go on from there into looking at some extra tips and then going on into our section all about goal setting. So today is going to be a fairly quick lesson. We're going to talk about the 4 indexes that I use, why I use them, how I use them, and some absolutely fantastic tools and tips for you. I think I have some really good stuff here of how I look at it, how I use these things, and some really good indicators that really shed light on what I do, how it helps me find good value, and act upon all the great things that I see in the market to really have a good winning percentage and lower my risk overall. So we're about to start building that third wall we want to work on right now with our large indexes. So y'all, with no further ado, let's get into it. So the first index that I use is -ES, or the SPY. Now the S&P 500 is usually considered the top 500 companies, usually in market cap, that move up and down together, and this is a great sign of how the stock market's doing. A lot of folks use this for the overall health of the market and how well it's doing. A lot of folks use the Dow 30 as well. Both have pros and have cons. The pro of the Dow 30 is that it's the top 30, and so when that does well, it's really good gravitational forces to pull people higher and pull our stocks higher. The negative is it's only 30 stocks, while the S&P has 500 that change pretty often, right? But it has 500, gives us a good variety, and it's a really good starting place for an investor to watch the markets. So I have some charting. I'm gonna show you what I do and how this works for me. So let's check out the S&P 500. So this is SPY, SPY. I like to use the 10-year occasionally. Come check it out. So this is what's interesting, because a lot of folks are like, oh man, we're always overbought, always doing so high. Well, I mean, this is fairly intense, but I mean, if we were to measure, like, let's just say from here over 570 days and made 30%, I mean, we can come back over here, 570 days here made about 37% too, and it never came back down. So a lot of folks who just overreact because they have short-term confirmation bias and like, it's always gonna crash. Well, I wouldn't go that far. This is a fairly intense uptrend, and I'm gonna keep that in mind of what we're doing. But I mean, you have your consolidation periods, uptrend. Consolidation periods, uptrends. This is what the stock market does. You go up, you come down some, you go back up, right? So what do I do when it comes to charting? What's going to be interesting and what I suggest you do, and we'll cover this, I'll put the letters on the screen. I only chart on the -ES while I keep the SPY clean, so I can always come back and do modifications to it. Where I'm going to show you some really good tips and tools on how to chart these together, but if I were to use the SPY, which is already clean, I use -ES, as we can see, for my charting. So if I ever have anything to look at SPY, I can use different kind of drawings, like, oh, maybe we're making a new trend line here, right? Let's see, oh, maybe we're making a new resistance here, maybe it's breaking out, yada, yada, yada. I don't gotta go back to -ES and mess with my charting, right? So the first tip for you, choose whether to have the spiders or the mini futures. The mini futures are -ES, -NQ, -RTY, and -YM as charting, or choose the chart on the spiders themselves, which are gonna be SPY, QQQ, IWM, and DIA. If you can have one of them being dedicated to all the charting and one being free for other things to add to it and modify and check and do some different tests on, that may make your life a whole lot easier, right? So this is SPY, SPY. I think it's important to understand that we have great structure within the stock market. You can just see clearly we have supports and resistances throughout. I mean, you have this resistance here becoming a support. You have this resistance getting tested here and tested there. This old resistance became a resistance again, support, all these kinds of great things. Everything with the stock market applies here as well. So what do I do to have good charting? I'm going to chart what we have now. So in a few years, you come back to this and the chart is not uptrending, it's consolidating and going down. Just do the same steps in reverse and try to do your best. The Russell's going consolidating sideways, so that'll be good for us to check out as well. But if it's downtrending or wedging, again, draw it and then redraw it and redraw it and redraw it as time goes on and changes. These will change over time for sure. So what I like to do first when I look at my charting is to find trend lines. Now, the S&P seems to have a nice uptrend just like this, right? And again, this has changed over time. You can see this uptrend over here was more of this angle, but now it's kind of taking off higher. So I'd erase that and go from here, just like usual. I'm going to draw myself a nice uptrend like this. I'm then going to duplicate this and come over and see if possibly this works out. It does work out very well. It's very intentional on purpose, right? So you can see a really nice resistance trend line here. That hasn't hit it recently. You could probably draw one like this and see it getting closer. But for now, this makes sense to me. Looks good. I like this where it's at. Great resistance trend. I'm going to extend left both these so I have it looking nice. So this looks pretty good here. What's next? I'm going to try to identify on the same angle, the same structure here, the same price structure, do we have regression lines or halfway lines? Does the stock bounce before these trend lines? And let's see if it does real quick. So what I'm going to try and identify is there trend lines for these bounces here, like this, and this. Does the stock bounce? Ooh. So does the index bounce off these spots too? I'm going to duplicate and bring this on up. And we can see it gets close, right? It looks like it looks pretty good. Probably about here would probably be a really good spot for it to bounce off of. Now it's a bit high. It's 2% wide for the index. It's probably pretty thick. So I'm going to come down and say probably right about here is good. So anywhere from here and down is a really good deal. Let's do the same thing with the resistance trend line. Let's come down and see if it bounces beforehand anywhere. I'd say probably right about there looks pretty good, right? Right here. We can see all the bounces that we got. Bounce, 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 bounce. Looks really good. Why is this important? Because in the stock market, what do you want to do? Buy low and sell high. Off the bat here, we've now established two spots of where we can say we buy low and when we sell high, right? So I think that maybe this resistance trend could be a little bit lower for the new structure that may be forming here. But for now, you want to buy anytime we get below this area. Looks really good. And sell up here. But that's only been what, 7-8 times this whole year. You're not going to be able to do that, right? So what you can do is add extra lines, or what I like to do is add a regression line. The regression line will go right down the middle and find where I think half the action's above and half the action's below. That way, when you get below the regression line, you know you're buying low, and when you get over it, you're probably selling high. Again, this only works if the price structure is pretty like this. A lot of the indexes always have these, but as long as this holds, that regression line will be invaluable to you to know when you're buying low and selling high. So with the same exact structure here, I'm going to take this line at the bottom, duplicate again, come up and find about halfway up. I'd argue it's probably right about here. Looks good to me. A lot of action bounces off this spot as well. Make this purple is what I usually do. And as we can see now, we have our buy low, which is this half, and our sell high, which is this half. Again, on smaller time frames, like the 10-day, whatever, you can see probably some new patterns forming. Like you can see in this trend line here, and apply the same exact concept right here with a regression line. You could have seen this wedge falling just like this. It's broadening wedge that broke out eventually. All these smaller time frames have this, but I have to use the macro scale because what I'm trying to do on my OTC tickers and my smaller time frame tickers is buy low, sell high. This is establishing where I could say we're buying low and we're selling high. Next, let's add our supports and resistances just like always. Interesting enough, which is not going to be very helpful, is that we're at all-time highs, so making a resistance doesn't make much sense here, but making support does. And we can see right here, an old resistance became a support. That looks really good here. Of course, we could probably come over here and say, all right, well, the resistance for now is here until it breaks any higher, and then we can move that up. But that's probably fine right there. And there's our charting for the S&P 500. One more thing I want to add. Historically, we have 5, 10, 5% pullbacks every few years. Not that many, but when it does happen, you know you have either A, a fantastic value, or B, you got about a month of recovery until you get back to where you were, which is a great time to buy, honestly. And so what I like to add to most of my S&P charts is a 5% pullback line. This way I can just track where I think the 5% pullback can come to, and that way I can look out for, because if it's a really big pullback, I know what's happening. We can see right there is a 5% pullback. I'm going to take my line here, put that there, delete this one, which is 5% from where it is, make this red, serious right there. Looks good to me, so now if we pull back to here, we now have a problem at a macro scale I want to check out as well. That's how I chart the S&P 500, and again, you can apply that at any time frame, whatever it is, but for now, that's what I use. The best tool, I don't like to say time in the market, but the best tool for me for my entries is the CCI indicator. What we're going to do, because the goal of this macro index right here is to tell me when we're at value at the whole market or we're overbought as a whole market. The CCI will show us when we pull back nicely. I'll show you. So we're going to use SPY for this. I want to show you the CCI indicator and how I can use it to enter my stocks at a better discount and with better timing than most people can. So we have negative 100, 0, and 100. Every single time we get below 100, let's mark it with a vertical line. Every single time we'll go through and see how successful it was. Now I'm going to miss a few just because it's so many. I don't want to get the charts all muddied up, but for most of these, we'll go through and see if we enter with technical analysis and with CCI being low, how would it have gone for us? Let's see. So there we go. Let's zoom in. So we can see with the regression line, would have been a good entry. Regression line bounce, good entry. Up here, not so much. And again, technically speaking, I would have entered anyways. Down here, it was okay. I mean, you would have gone green, 3% green. But again, that was not the best entry here. Here, off the regression line, looks good. There, looks good value. Again, not great value. But even here, on the pullback on this one, 2.67% CCI was low. And again, here, it would have been burned, but it would have made money. Would have been a great entry there. And as we can see, with the CCI being below 100 and closer to 200 is better, it looks like a really good entry when it technically lines up. Like right here, hits this trend line perfectly. A nice run up for almost 6% on the S&P by itself in only a few months. That's fantastic. So the CCI tied with a low technical value is a fantastic spot to enter the market for a short-term swing. Let me show you my CCI on the Dash ES. What's super cool about this is that I actually went out and measured where I think a lot of bounces do happen. We have a negative 150. That's my higher risk, lower reward spot to enter. At negative 200 is my medium risk, medium reward to enter. And at the bottom is my very high reward, very low risk. And as we can see with that, I probably get, 20, 30, 40 good days to enter here. And again, these are my best swing spots to enter. And when it comes to taking profit, the same exact thing. We have our taking profit probably looks like a good idea, and taking profit's probably a really good idea right here. So I myself even add lines to my CCI to show the best entry spots. The main issue with a lot of beginner traders, if they see the market going down, they sell everything and get nervous. What you should be looking to do with the CCI on the Dash ES or SPY, whatever it is, as CCI gets to negative 150, negative 200, or a good value, and the technical analysis makes sense, that's when you buy, right? You want to buy low, sell high. And as we can see in the structure, at least, 9, 10 good times so far for long-term holds. You've had fantastic entry points. Now, of course, off the regression line, even more. Bunch of bounces there. Fantastic, fantastic. You would have plenty of days to trade. Maybe 40, 50, 60 days to be really active. Other days just to hold and watch. And again, this is not a job. This is supposed to be outside the employee mindset into the investor mindset. Not every day is a good day to buy stocks. I'm sorry. Would you want to buy stocks here at this resistance trend line holding it beautifully but bouncing off here? Probably not so much. But down here, yeah, definitely. So that's the first index that I use. It's the first spot I go to. And again, it's for value. And when it comes to my value, this is also my indication for how long I should be holding this trade for, honestly. So if the index is towards the bottom of the price structure, I'm more likely to hold for longer. If it's towards the regression line, I'm going to hold for maybe 4 or 5, maybe 6 days at most. At the top of this price structure, I'll hold for a day or two and scalp. Now, as the structure goes from a channel up to maybe consolidation or wedge down or wedge up, this will obviously change, but again, the principle is the same. The lower I am on this price structure, the more likely I am to hold for a long period of time. So we were to come over here to this area. It's not the best angle. Let's do that. Anywhere down here, these two golden lines, the support. Anywhere down here, I'm likely to hold week, 2, 3 weeks. Anywhere in here, from about here to here, as time goes on, if price stays in this area, I'll probably hold 4 or 5 days. If I buy a stock that's towards the top of the price structure up here, I'm probably going to hold for a day or two at most, right? And historically, that's worked out to my advantage, right? Anywhere in here, you buy it towards the regression line, you could probably hold for about what? You've been to hold for 6 days to profit. Down here, a full move of 8%, but up here, you bought here, you got 1.39, but then it crashed 5 days later. So I use the S&P as the structure goes on to buy low, buy medium, or buy high, but then also sell high up here. So it's my first place to look for actual value. If the S&P is on value, more times than not, every sector is going to probably be on value, right? That's what I usually like to see. After the S&P importance is probably the NASDAQ. I don't really use the NASDAQ all that much because usually the S&P and NASDAQ move the same kind of directions. If these get kind of confusing and they kind of start to go opposite directions, the market gets kind of wacky, but otherwise they move the same direction. It's good to have for charting though, just to make sure. So the NASDAQ is going to be extremely tech heavy, and they have no financial sectors in it usually on the QQQ NASDAQ 100. So it's important to understand this is going to follow mainly tech, consumer services like restaurants, your retail trading, your travel agencies, healthcare, industrials, and comm services. So this is probably a good place to start if you want to see how tech, healthcare, industrials are doing, not so much how financials are doing. But let's check the chart. Again, it's very much the same as the S&P right now. So we can see a really beautiful channel up again on the 10-year. It looks very similar, doesn't it? Like this and Dash ES look very, very similar. Now the NASDAQ is at a little bit worse of a value on the spider here, on the mini future. It's not nearly as good as a value, and again, that's important for me to understand. But on the 1-year chart here, I mean, this has been holding up very beautifully. I mean, it bounces beautifully. The 1-year chart's fantastic for these kinds of things. It's bouncing right here. But I consider this to be a good deal. Absolutely not. On the Dash ES, is this a good deal? No, not really. Especially if I make a new trend line and follow this one, it's getting up there as well, pretty high too. But with the Dash NQ, now I know I'm probably not going to want to buy stocks up here, right? I want to buy a little bit lower. As time goes on, this may change. I mean, you have a possible trend line like this forming, whatever it may be. But again, for now, buy low is down here, buy mediums here, and buy high is here. I don't use the NASDAQ for that really just because it's not the best tracer for that. It's just a good indication of how the overall stock health is doing. If NASDAQ goes up, a lot of stocks go up. If the NASDAQ comes down, a lot of stocks come down. I'm not going to use it all that much, but in case the S&P and the NASDAQ become, diverge and one's going up, one's going down, it's important to check it. I don't love it like that much. I like the Russell more, but the NASDAQ is the second one I check for, again, directional strength and trend. But as we can see, it's so high towards resistance, I'm not overly excited about it. It's been like that for months. But if the NASDAQ took a nice 15% pullback, that would change my mind. But again, I chart the same exact way, just like the S&P. We have our trend lines, we have our buy low spots or sell high spots, our regression line, and this may change as time goes on. A good chance it maybe looks more like this as a regression line, and we're not too far up there. And maybe the resistance trend line is getting more kind of like this. We're gonna see, right? But as for now, it's really high up here. I don't love it. Anywhere lower is probably great. But the Russell 2000 is a fantastic example right now. So the Russell 2000 is what I use as a bellwether for how the economy is doing, because it has 2,000 stocks on it, which is way more than the S&P or even the Dow 30 or any of these kinds of things. And it's a large enough market cap for these that it's significant, but it's not like your Walmarts and your Apples, right? So I like to use it as my really nice indicator for how the market's actually going to be doing. It's also going to give small caps and the really small tickers another good level of gravitational pull. If this goes up or down, more than likely a lot of tickers will do the exact same thing. Let's check out the Russell real quick for you. So for the Russell, this is RTY. You can see IWM is the exact same setup, but for the Russell 2000 right now, we can see it's been in a gorgeous horizontal channel. Now, it usually does this. I mean, you can see in the 10-year chart, it's gone sideways for years. Sideways. It's recently gone back up. But this is a great way to finding great entries because, again, it goes off supports and resistances. Every time you're below 212 right now, you have a great value. It just broke this trend line, honestly. But up here, not the best value, but it bounces off these spots beautifully. If I turn on CCI indicator, which we always talked about being a good value finder, turn that on, we can see again, I've drawn extra lines here. We're now towards 250. Last time we did that, we went up and then came right back down. Up here, 250, and came right back down. So again, anywhere above this dotted line, I don't want to buy anything. Down here, I want to buy stuff. And we can see recently, this pullback here, got to negative 200, but over here, negative what, 300, 250? Yeah, negative 250, easy entry, super easy read. So we can see even when the markets consolidate, you can pinpoint great value, swing it to the top, and make plenty of money. Secondly, why the Russell's so cool is I use it as a benchmark against hedge funds and a benchmark against mutual funds and ETFs. The Russell 2000 is a fantastic way of saying if it's made 20, 30% this year, the mutual funds or ETFs or whatever I like, the hedge that I want to go with, they better be outperforming it. If you can't beat the Russell 2000, why would I invest in you, right? Because if they're going to have a massive diversification, their diversification better beat the Russell 2000. I'll show you. So let's say I want to see how well a mutual fund's doing. I'm going to come right here. This is 1 year ago. Come all the way up and see that currently the Russell 2000 is up 42%. I'll give them a benefit of the doubt, and before this move was 38%. So last year the Russell 2000 moved up almost 38%. A hedge fund or a mutual fund better be beating this. I'll show you a website to see the best ones, and let's see how good they're doing year to date. So the Russell 2000 was 32% and recently 42%. We can see All Cap Opportunities Fund is at 47. That's not bad. All Cap Opportunities Fund I-Class is 47, 36, 36. Right, these all look pretty good, but like Credit Opportunities Fund is only at 14% compared to the Russell 2000 being at almost 40. That's a horrible sign for them. EM Markets Corporate Bond's not looking very good. I mean, that's not great either. Emerging Markets not looking very good. Right, so a lot of these are underperforming. Like Financial Services Fund, it's higher, but again, made 68%. That's pretty great. So you can go through this whole website and find some of the best 4 and 5 rated star ones and see which ones are doing the best. And again, comparatively, I mean, year to date, we can even check that as well if we really wanted to. We can find January 1st real quick. We're somewhere right about here, over about there. So from January 1st or so, it's up 8%, right? So this website, yeah, I mean, 8% up, but this is up 19. That's a great sign. That's a great sign. Negative 1.37. Ew. Right, so you can go through this whole website, which I'll link for you, obviously, and you can find some of the best returns, some of the best mutual funds and such, and go against the Russell 2000. That's what I use it for, because if I'm going to buy, a basket of stocks, I might as well see how well it's doing compared to the Russell 2000, which has been fairly consistent. And if it's beating that, it's probably going to be a just fine investment, honestly. And lastly is the -YM or the Dow 30. This is a great indicator of the overall market's health. It's also constantly changing. A lot of tickers come in and out of it depending on market cap. This is basically going to be the S&P 500, but it's with 30 stocks instead of 500. It's made up of, Microsoft, Apple, McDonald's, Nike, anything that is huge, JP Morgan's on it, whatever it is. It's just a massive, massive blue chip indicator. When this does well, the whole market does well. I use the S&P to find really good value, and I can buy low, sell high. With the Russell 2000, I'm using that to find mutual funds that beat the market usually, and also for my small caps. The Dow 30 is where I buy my long-term investments. I'm looking for something that's a great dividend, long-term hold, that's at value, that I can buy low, hold for years, and sell high, right? So this is the -YM. Again, it's going nicely up here. We can see over the 10-year chart. This is a nice build-up, and again, you can come over here and see this trend line here was what it's going off of for years. I mean, for almost 2 years, it did this perfectly. Over here, farther back, beautiful trend line up. I mean, this is what the indexes do, folks. Get used to having these kinds of things. Look at that. Bounce, 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 bounce. Every single time. So when the market comes down to those little trend lines that I like, I buy my long-term holds. So every single time the market and the -YM comes down beneath this dotted line or even this regression line, every single time it's come down here, 5 times this year so far, would have been fantastic purchasing. I mean, it would have come up here and made 8%, could have made 8.9%, an easy looking 6%. All the stocks on the -YM, when it dips that far, I'm looking to buy. Plenty of times this has happened, I'll show you. So whenever it dipped down here, we'll go to Nike real quick, which I've called and actually loved playing myself. Nike dipped down perfectly with the -YM and then took off great. Same with McDonald's. Dip, 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 ran up well, dip, dip, dip. These dips do line up pretty well with the -YM. You can see how they dip the same exact times basically with the larger overall index. We also have something like Home Depot, the exact same thing, dip, dip, dip. Oh, I called that, who knew? Dip, 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 now it's running up. So every single time we see large caps, I'll take a dip. I'm looking to buy them and hold for those dividends and that growth thereof. And there you guys have it. Those are the 4 indexes that I use. Again, it's super important to understand. -ES or SPY is what I use for the overall market being at value. When it dips low, I buy low. It goes back up, I sell high. The Dash NQ or QQQ is a great indicator of technology, healthcare, and industrials overall, and telecommunications as well. Whenever that is low, you can buy those tickers in that sector low. But again, it's the same thing as the Dash ES. It's more diverse and it gives you a second lens on where the market really is. The Russell 2000 is my personal favorite for small caps and mid caps, but then also I use it against mutual funds and ETFs. If they're not outperforming the year to date or just the 365 days of the Russell, it's not a good choice right now. I don't love it. If it's beating it, I do like it for a purchase for a long-term hold. And lastly, the Dow 30 or DIA with Dash YM, that's where I buy my long-term holds. When that thing dips into that little channel that we drew, and again, that'll be on any time frame, you'll find those kind of entries. I use the 180 day. When you dip like that, that's where I buy my long-term holds and my dividend stocks. That's what I use those indexes for. Next, we're going to discuss sectors. There's 11 of them, a little bit more intense in this lesson. We're talking all about regression, or we're talking all about charting them, finding our G graphs, how we use that in all these kind of different types of business cycles, all those kinds of great things. With that being said, let's check out these sectors real quick.